What's up everyone, it's Scotty with Money Investing. In this video, I wanted to talk a little bit about Tesla and really go over a very important tailwind for the company, which I don't think anybody is talking about because it is literally staring us in the face, but it's not really that obvious because there's a lot of uncertainty and a lot of question marks around that. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. We're going to take a look at Tesla's average cost basis among all investors in the market, do a little bit of technical analysis, and I'll also go over that one catalyst, that tailwind, which could really just explode Tesla's deliveries in the years to come. So again, link's going to be down below if you are interested in joining us, and let's just dive right into it. And the number one thing that is going to really provide a lot of value to Tesla over the long term is going to be interest rates. Yes, I know it sounds way too simple, but interest rates obviously have been going higher, and this has been the fastest modern day Federal Reserve monetary policy hiking cycle of over 500 basis points. And if you take a look at simply the actual auto rates, right? So rates that are used to finance vehicle purchases, this right here is the monstrous chart, which as of June 2023 is obviously sitting at over 7%. You'll notice that since 2014 all the way through 2022, this rate was pegged between 4 to 5%. And now it's trading at over 7%. And this is all on the back of the Federal Reserve's hiking cycle, because obviously we've seen rates go higher and higher over the last 12 to 16 months. And they're expected to go another 25 basis points next week in July to sit somewhere between 5.25 to 5.5%. The market expectations are pretty much 99.8%, so pretty much a done deal at this point. But this entire move that's come from sub 4% to over 7% is pretty significant. It's a 50% increase in the cost of borrowing alone for the vehicles. And in my opinion at least, and of course I'm sure you guys will agree, we are very much towards the end of this hiking cycle, right? The Federal Reserve's maybe got another 25, maybe another 25 later down the road in the pipeline, maybe another 50 basis points left remainder of 2023. But then we're expected to obviously stay higher for longer, and that eventually if and when inflation turns into disinflation and deflation, or if the economy starts showing some cracks of a potential recession, rates are going to start coming back down. That's why the market's pricing in significant cuts, obviously, for interest rates over the next year in 2024. Now, why is this so important? Well, majority of vehicle purchases are financed. So 84% of new cars in the United States were acquired using some kind of financing in 2022. And the percentage of new cars that were financed has been relatively stable over the past few years. In 2020, 85% of new cars were financed, and in 2019, 86%. So you will start to see that in 2023, the financing activity has dropped because of higher interest rates, right? The first 6 months of 2023. And despite this fact, despite interest rates being higher and the financing has been a little bit more, the cost of borrowing has been a lot more, Tesla's still been able to produce significant amount of demand, right? The deliveries have been absolutely incredible. We just got the record quarter, last quarter, 466,000. We just got the earnings. Of course, margins have been a little bit of an issue. So when interest rates obviously are going higher, Tesla is able to lower prices. They've got that flexibility and pricing power to obviously boost demand once again. But in my opinion, eventually in 2024 or even over the next couple of years, as interest rates are lowered and the Federal Reserve is meeting its target with respect to inflation, when inflation's back down to 2%, and we are seeing economy continue to be very strong, or if we see any type of recession probabilities, interest rates eventually will get cut down, and there is a possibility that we do settle once again in the 4 to 5% range, or at least up to as much as 5.5%, which could once again spur the demand for vehicle borrowing and financing cost once again. So this is, I mean, what I'm trying to say is the hard part, the worst is behind us, because the interest rates have already gone up so much, and people who wanted to finance have kind of held back a little bit. And even despite all this, Tesla's been able to report record deliveries, 1.3 million last year. They're on track to doing over 1.8 million this year. And of course, in 2024, if and when the rates start getting cut, I would expect nothing but deliveries to increase, production to increase even further as there's more demand that comes in with the lower cost of borrowing. So hope that makes sense. And of course, Tesla one of the kings in operating leverage. Operating expenses versus revenue has literally gone parabolic. This was one of the charts that was mentioned yesterday in Twitter. I didn't get a chance to go over it, but it basically suggests that revenue is growing at a significantly much faster pace than operating expenses. So the company is able to generate a higher operating leverage, which is where most of that profitability comes from. So over time, when Tesla is doing a lot more volume and potentially gets up to 5, 10, 15, 20 million vehicles per year, that's when you will see the profitability of the operating leverage. Right now, it may not seem as obvious. It may not actually translate over on the actual numbers because we're working with not that many cars compared to some of the other automakers, but eventually the operating leverage will play a key role in Tesla's long-term profitability as Tesla becomes, very, very significant player in the EV market. It already is, of course, majority of the market share, but when we get to 5, 10, 15, 20 million vehicles per year. Now, this right here is going to be the cost basis distribution. So we are looking at an average cost of about $248.28 right now among investors. That puts us a little bit under 53% of the total shares that are currently profitable for Tesla. And again, this was a headline that was released yesterday. Tesla's margins remind us that it's an automaker and not a tech company. And it's kind of crazy because Tesla did have over 20% margins for the very long time. And more recently, because of the rate of borrowing costs. And, that's the thing, right? It's not just about the cost of the vehicle that's coming down, like in terms of raw materials. Elon Musk is a smart guy, right? He senses that rates are higher, people not financing these vehicles as much as they used to. They're not buying new cars because the cost of borrowing is higher. So what does he do? He's lower prices to boost that demand. Obviously, margins going to get affected, but again, the hard part, the worst part is kind of behind us, and we're already starting to see the end of this hiking cycle. We can kind of see the light at the end of the tunnel with respect to interest rates, and eventually when they do get cut, we can start to expect a lot more demand that comes in for vehicles, and Tesla will have the flexibility to maybe raise prices once again increase those margins. And of course, at that point, we'll also have the contribution of FSD, solar, Optimus robot, and a lot of other initiatives that Tesla's working on. So going over to the technicals here, this right here is going to be the entire analysis. As I mentioned in my yesterday's video, I wouldn't be surprised for Tesla to be trading at roughly 240. Going into next week, I could see that level for Tesla. That's going to be sitting right over here, in line with the support and in line with the daily 21, the moving averages. We're already starting to see a breakdown, so we're definitely seeing a bit of a technical breakdown here. This past week, Tesla was down a little bit over 7.5%. So next support really is going to be sitting at that level from back in June, sitting roughly at around $240 per share. And of course, all the way down to inside this green rectangle, sitting in the 220s, 215s, which would be a very, very decent support for Tesla, in line with this previous resistance, acting as a new support for this company. But of course, my fair value is going to be in the 150s and 160s, where I'll be very much interested in maybe dollar cost averaging a little bit more aggressively and buying more shares of this company once again. So that's going to be sitting all the way down here for Tesla, which obviously is a lot lower, but I'm looking for good deals and I don't want to overpay for certain stocks. So support level is going to stay put at 240. That's the level to watch going into next week. Resistance is going to stay put at 275 to as much as 300. And next support is going to be in the 200s, low 200s, 220s, 215s. Very nice reversal could be seen. A nice swing trading opportunity could be there for Tesla here. But my fair value is going to stay put at 150s for the company. So I hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. And what do you think about Tesla? Like I said, as interest rates have gone up, cost of borrowing has gone up for auto loans. And since 84% of the United States, basically 84% of the population finances a new vehicle, it makes it more expensive when rates are 50% higher from where they were, right? 4% to 7%. That lowered the demand, but Tesla had the pricing power to lower prices in order to boost that demand, still represent record deliveries. But eventually, over time, as we progress and foresee over the next couple of years, as interest rates do get cut and come back down, that in itself could really spur some demand, and in my opinion, could explode Tesla's deliveries over the long term as well. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. As always, happy investing. I'll see you all in the next video.